What if I told you that a handbag could outperform the stock market, that a wristwatch could appreciate faster than real estate, or that a silk scarf could be worth more than a used car? Welcome to Exposed Extravagance. In upcoming videos, we'll explore how privacy, access, and power are reshaping luxury in 2026. Subscribe if you want to follow that shift as it unfolds. Today, we're diving into the world of luxury items that have become legitimate investment vehicles. Pieces that have skyrocketed in value over the past few decades, turning collectors into millionaires and reshaping how we think about wealth. We're not talking about owning these items for status. We're talking about the economic forces, the cultural shifts, and the strategic scarcity that transformed everyday luxury goods into financial assets. From Birkin bags that sell for hundreds of thousands of dollars to Patek Philippe watches that auction for millions, we're breaking down exactly why these items became investment gold. Let's get into it. Let's start with perhaps the most famous example, the Hermès Birkin bag. In 1984, actress Jane Birkin complained to Hermès CEO Jean-Louis Dumas about the lack of practical yet elegant weekend bags. By the end of that flight, the Birkin was born. Fast forward to today, and these bags regularly sell for $50,000 to $500,000, with some rare examples breaking records at over $2 million. Here's the staggering part. Studies have shown that Birkins have appreciated an average of 14% annually over the past 35 years. That beats the S&P 500 over the same period. A bag has outperformed the stock market. But why? The answer lies in manufactured scarcity combined with insatiable demand. Hermès doesn't advertise Birkins. You can't just walk into a store and buy one. The company strictly controls production, with each bag taking 18 to 24 hours of hand stitching by a single craftsperson. Hermès reportedly produces only around 12,000 Birkins per year globally, while demand is exponentially higher. But it's not just scarcity, it's strategic exclusivity. Hermès has perfected what economists call Veblen goods, products where demand increases as the price rises because ownership signals extreme wealth and access. You typically need an established purchase history with Hermès before you're even offered the opportunity to buy a Birkin. This creates a waiting list system that can span years. The investment angle became formalized in the 2000s when collectors realized that certain colors, leathers, and hardware combinations appreciated immediately. A crocodile Birkin in a rare color might be offered at $80,000 and resell within months for $120,000. The secondary market exploded, with platforms and specialists emerging to authenticate and broker these transactions. What really accelerated Birkin values was the entry of institutional investors and the wealthy from emerging markets. Chinese and Middle Eastern buyers began acquiring multiple bags not for use, but as portable, appreciating assets. Unlike real estate or art, a Birkin is relatively liquid, requires no maintenance, and can be transported across borders easily. The ultimate validation came when investment funds began purchasing Birkins as alternative assets, treating them like stocks or commodities. When finance treats a handbag like a bond, you know something fundamental has shifted in luxury markets. If Birkins are the queens of fashion investment, Patek Philippe watches are the kings of horological value. This Swiss manufacturer, founded in 1839, has created timepieces that have sold at auction for over $30 million. The Patek Philippe Grandmaster chime sold for this record amount in 2019, but even standard models have seen extraordinary appreciation. Take the Nautilus reference 5711. When it launched in 1976, designed by legendary watchmaker Gerald Genter, it retailed for around $3,000. Today, that same reference in good condition sells for over $100,000 on the secondary market. That's not just inflation. That's a 33-fold increase in real value. What drives this appreciation? 3 interconnected factors: finite production, technical mastery, and brand positioning. Patek Philippe produces only around 60,000 watches annually, a deliberately constrained number that ensures each piece remains special. Compare this to Rolex, which produces nearly 1 million watches per year. But it's not just about making fewer watches. Patek has cultivated a brand philosophy summarized in their famous advertising: You never actually own a Patek Philippe. You merely look after it for the next generation. This generational narrative transformed watches from accessories into heirlooms and investment pieces. Patek became the watch you bought not for yourself, but for your children and grandchildren. This long-term holding mentality restricts supply even further while elevating the emotional value beyond mere function. The technical mastery cannot be overstated. Patek Philippe holds numerous patents and creates some of the most complicated mechanical watches ever made. Complications like perpetual calendars, minute repeaters, and celestial displays require years of training to master and hundreds of hours to assemble. In an age of cheap quartz accuracy, the mechanical watch became art, and Patek positioned itself as the museum-quality option. The investment market for Patek watches formalized in the 90s and 2000s as specialized auction houses like Christie's and Sotheby's began holding dedicated watch sales. Suddenly, price history became documented and transparent. Collectors could track appreciation. Wealthy buyers began purchasing multiple references specifically for investment. The discontinued models phenomenon further accelerated values. When Patek discontinues a reference, secondary market prices often spike immediately. The announcement in 2021 that the steel Nautilus 5711A would be discontinued sent prices soaring over $200,000 overnight, more than quadruple the retail price. What we're seeing is the financialization of horology. Watches have become alternative assets, with dedicated funds, investment advisors, and market analysis. For the wealthy seeking to diversify, a collection of Patek Philippe watches offers appreciation potential, portability, and the pleasure of wearing investment-grade art. Let's talk about something unexpected: silk scarves. Specifically, rare vintage Hermès scarves that now sell for thousands of dollars apiece. Hermès has been producing silk scarves since 1937. These 90-centimeter squares, known as carrés, feature elaborate designs by commissioned artists and require specialized printing techniques. Most scarves retail between $400 and $900 new, but certain vintage designs have appreciated dramatically. A rare early scarf from the 1940s or 50s in pristine condition can sell for $5,000 to $15,000. Special editions or scarves with errors in production have sold for over $30,000. What's happening here? The scarf market demonstrates how collectability combined with fashion creates investment value. Unlike bags or watches, scarves are inherently fragile. Silk stains, fades, and tears. The survival rate of scarves in pristine condition from decades ago is low, creating natural scarcity. But knowledge is power in this market. Serious collectors study the archives, knowing which designs were produced in limited quantities, which colors are rarer, which artists are more collectible. This information asymmetry allows informed collectors to find undervalued pieces at estate sales or vintage shops and resell them at significant markups to wealthy buyers who want specific designs. The scarf investment market also benefited from the rise of online platforms where collectors worldwide could connect. A collector in Tokyo could sell directly to a buyer in Paris, eliminating geographic barriers and creating global price discovery. What's fascinating is that scarf collecting demonstrates the democratization of luxury investment. While few people can afford Birkins or rare Patek watches, entry-level vintage Hermès scarves can be acquired for hundreds of dollars, making this market accessible to middle-class collectors who develop expertise and build portfolios over time. Now let's shift to the automotive world with limited edition Rolls-Royce models. While most cars depreciate rapidly, certain Rolls-Royce vehicles have become appreciating assets worth millions. The classic examples include pre-war models and 1950s Silver Clouds, but even modern limited editions have appreciated. The Rolls-Royce Phantom Drophead Coupe, produced from 2007 to 2016 with only about 250 units made globally, has held its value remarkably well, with pristine examples now selling at or above their original retail prices. The investment case for limited Rolls-Royce models rests on several pillars. First, brand heritage. Rolls-Royce represents the absolute pinnacle of automotive luxury, with over a century of history supplying cars to royalty, heads of state, and the ultra-wealthy. This heritage creates enduring value. Second, engineering excellence and materials. These cars are hand-built using premium materials, from lamb's wool carpeting to wood veneers book-matched from single trees. The build quality ensures longevity, critical for collectible vehicles. Third, extreme limited production. Rolls-Royce produces only 4,000 to 5,000 cars annually across all models. Special editions might number in the dozens or low hundreds globally. This scarcity, combined with the brand's refusal to dilute its positioning, maintains exclusivity. The collector market for Rolls-Royce crystallized when auction houses began featuring these vehicles prominently. Classic models from the 20s and 30s now regularly sell for $1 to $3 million, with exceptional examples exceeding $10 million. Buyers are increasingly institutional, with classic car investment funds acquiring vehicles specifically for appreciation. Modern limited editions follow a similar trajectory. The Rolls-Royce Sweptail, a one-off commissioned vehicle rumoured to cost $13 million, immediately became one of the world's most valuable new cars. Even if the owner never drives it, the vehicle represents a unique asset, unlikely to depreciate. What's interesting about automotive investment is the dual nature. These vehicles can be enjoyed while appreciating. Unlike art locked in climate-controlled storage, a collector can drive their investment, albeit carefully. This utility adds psychological value beyond financial returns. Finally, let's examine vintage and estate jewellery, a market that has exploded over the past 2 decades. Pieces from houses like Cartier, Van Cleef and Arpels, and Bulgari from the Art Deco and mid-century periods have appreciated dramatically, often outpacing contemporary jewellery. A Cartier Art Deco bracelet that might have sold for $10,000 in the 1990s could easily fetch $100,000 or more today. Signed pieces from the great jewellery houses have become art investments, treated similarly to paintings or sculptures. The appreciation drivers here are fascinating. First, there's the artistry and craftsmanship. Mid-century jewellery often features design innovation and hand craftsmanship that's economically unfeasible today. These pieces represent a level of detail and creativity that modern production cannot replicate at scale. Second, provenance matters enormously. Jewellery with documented history of ownership by notable figures can sell for multiples of similar pieces without that story. A brooch worn by a Hollywood icon or royal figure carries premium value. Third, the rise of auction transparency and certification has professionalized the market. Buyers can verify authenticity, track price history, and compare across global sales. This transparency increased confidence, bringing institutional money and serious collectors into vintage jewellery. The portable wealth aspect cannot be ignored either. Jewellery represents extreme value density. A bracelet weighing a few ounces can be worth hundreds of thousands of dollars. For the internationally mobile wealthy, jewellery offers a way to move significant wealth across borders legally and discreetly. The investment thesis for vintage jewellery is also supported by material value. Unlike handbags or scarves, fine jewellery has intrinsic value from precious metals and gemstones. Even if fashion shifts, the materials retain base value, creating a floor price. So why did these luxury items skyrocket in value? The answer is a perfect storm of factors that transformed them from consumer goods into investment assets. Controlled scarcity by prestigious brands created fundamental supply constraints. Growing global wealth, particularly in emerging markets, expanded demand exponentially. The financialization of luxury through auction houses, specialized dealers, and even investment funds created transparent, liquid markets. And critically, these items offered wealthy individuals and institutions alternative assets for diversification, especially during periods of economic uncertainty. What we're witnessing is a fundamental shift in how luxury operates. These items exist at the intersection of art, fashion, engineering, and finance. They're Veblen goods that also function as stores of value. They signal status while potentially appreciating. They can be enjoyed while serving as investments. For the merely curious, this world offers fascinating insights into economics, psychology, and culture. For those with capital, it presents genuine investment opportunities. Though, like any asset class, success requires knowledge, patience, and often significant initial capital. The luxury investment market isn't going anywhere. As long as humans value beauty, craftsmanship, exclusivity, and status, and as long as skilled artisans and heritage brands can create objects of genuine scarcity and quality, these items will continue to command premiums and appreciate over time. What do you think? Would you invest in luxury goods if you had the capital? Or do you think this whole market is irrational? Let me know in the comments below. If you enjoyed this deep dive, hit that like button and subscribe for more content on investing, economics, and the fascinating stories behind value. Thanks for watching, and I'll see you in the next one.